Ticking red and green, actually. Bank Nifty is negative. Nifty's flashed a little bit of negative. So the profit taking that we saw yesterday, that continues into the opening moves this morning. Let's see what's down. On the downside, Asian Paints, HDFC Bank, Axis Bank, Kotak Mahindra Bank, actually financials are weak. ICICI Bank is also slightly red this morning. And there's Grasim, there's some profit taking on IT names like Infosys as well. Lever is down. So it's a bit all over the place, you'd have to say. The Nifty is now taken a more decisive move, 30 to 40 points on the lower side. A lot of IT seems to be seeing profit taking. HCL Tech, Tech Mahindra. Banks are a little soft. That's what's going on for the time being. On the upside, Wipro is a bit of an exception with the announcements that they've made, 1% up. M&M is seeing some traction, 0.5% on the upside. And some of the metal stocks, Nigel's favorites, they've had a good week, actually. And some of that continues this morning as well. Hindalco, for instance, is still up about 0.5%. But hard to say. I mean, there's a nice tussle between the bulls and the bears. Right now, the Nifty is flat, just 10 points lower.
Well, that's right. There should be, a few stocks that are calling for attention. Ashoka, Bilcon, that they have been temporarily suspended from participating in the ongoing and future NHAI bids for 1 month. They've got a show cause notice for construction of the 6-lane elevated corridor in Kerala. So that one's taking a hard hit. That's down in today's trading session. One of the top losers, GAIL. Well, it's trading 5% lower, but it's seeing some kind of support at lower levels. So we'll keep an eye out on that one. The other few stocks that are moving up, Lenskart. There's a Jefferies note that's come in, initiating coverage on Lenskart, and they have a target price of around 500 rupees. They believe the company is well placed. The stock, in fact, is up close to around 2.5%, and it's moving on rather good volumes. Another one that's doing well is Nectar Life. I think they're going to be considering a buyback, so the street likes that. That stock is up and about in today's trading session. Varun Beverages as well is up close to around 2.5%, and on decent volumes as well. So that one, in fact, is up and about. MTAR Tech, let's pull up that stock. The promoter entity, Kavita Reddy, sold close to around 2.5 lakh shares, but you had Bajaj Finserv, Motilal Oswal, both of them were good buyers in trade. And Whirlpool, yesterday you saw some large names buying from the promoters. Promoters sold close to around 11.5% stake, and some high pedigree names came in there. HDFC Mutual Fund, Kotak Mutual Fund, ICICI Pru, among others that did participate in that. So net, it's a flattish start, but broader markets, you have plenty of stocks that are dancing away.
No, absolutely. GAIL is still down about 5%. MCX is seeing some profit taking. Ashok Leyland yesterday, both Tata Motors, CV, and Ashok Leyland, the commercial vehicle players, both these stocks were up and about. There's some profit taking this morning on Ashok. Let's pull up Tata Motors CV as well. Yeah, that's also down about 2% as we see. So, Sammy Hotels, you heard the management on the show yesterday, sounding very, very optimistic about their second half plans. Sammy did a nice jig yesterday, it was up 5-6%. There's some profit taking on the stock this morning. Let's see what is managing to buck the trend. Varun Beverages, like Nigel mentioned. VST Tillers and Tractors, there's about a 3% up move over there. So this is what we have. Early trends. Hudson Agro, 3% up here as well. The Nifty, by the way, has turned positive. So the bulls are trying to fight back. Tata Motors PV and M&M are interesting stocks to watch. And some of the financials seem to be, turning a corner. Financials, Reliance, and some IT names. So this is looking very interesting. Lever is now positive. Reliance is now positive. SBI is positive. ICICI Bank is positive. So this is an interesting start. Volatile, but we'll see. Bulls versus bears, the fight is well and truly on. Okay, since we're discussing financials, let's quickly round up that conversation with Pranav. Pranav, let's move on now to Tier 2 banks. So much happening, so much deal activity. J&K Bank just told us that they also are, very keen to come to the market for an equity fundraise, maybe by Q4. In the Tier 2 space, what will you watch out for and what do you like?
Yeah, I think in the broader Tier 2 space, we are seeing activity given that it's clearly a benign environment. So if somebody wants to push for growth, this becomes a very nice setup. But most of them are fairly valued at this point. We don't see something that is strikingly cheap. And a big re-rating for some of these will require a strategic shift. Now, large investments would help, but you would need more than investments to pull off some of those strategic shifts. So we'll wait and see if someone can start delivering meaningfully higher ROAs than where they are today. But otherwise, most of these mid-tier banks are relatively well priced. So nothing that screams out as a buy for us.
Okay, all right. Hi, Pranav. Good to see you. And Pranav, for the sector on the whole, credit growth has been lacking. Are you seeing signs that there is some kind of uptake out there? And for the second half of the year, what are you factoring in terms of credit growth for the industry on the whole? And what would that mean for FY26?
Let's see, FY26, we expect about 13% growth. Two, three things will help. One is we have seen some uptick from all the consumption boosting measures of the government, be it the GST cuts and rate cuts and tax cuts. So that has started to show up in the latest quarter numbers. So that's number one. Number two, you also have a favorable base effect because last FY25, the real slowdown happened towards the second half. So the base effect starts to look a lot better. And third, we have some of the regulatory relief as well. So, for example, the bank lending to NBFC is slowly starting to come back. And that, again, had come off last year because of that increase in risk weight, which has now been reversed. So put all of these factors in, we do expect about a 13% growth towards the end of FY26.
Okay. All right, Pranav, we'll leave it on that note for this morning. Thank you so much for joining in. Good to have that conversation, that perspective. You have a great Friday, and we look forward to talking again soon. With that, let's move on and welcome our market master on the show today. Shailesh Raj Bhan, CIO Equity Investments at Nippon India Mutual Fund, is with us. Shailesh, what a pleasure to have you in. We haven't spoken in a while, so good to see you back on the show. And you're coming in at an interesting time where, yes, it's an all-time high, but it's a bit of a hated all-time high, or I call it the all-time high of disbelief. Doesn't feel like an all-time high. People are not dancing. There's no pom-poms out and all that. So what's your sense when you look at the market now? Slow grind, last 12 months, not been easy. What do you think? What's coming up ahead?
Yeah, hi, good morning. See, it's if you look at the internals of the market, right, and you've seen different segments of the market actually have suffered fairly significantly. So YTD, if you look at it, there has been correction in small caps and consolidation in, say, large caps and mid caps broadly. And the differential between small cap indices and the large Nifty indices is close to 17-18%. So there has been a substantial under the radar kind of correction happening, especially in the frothier markets of the past, which we had seen last time 12-18 months back. So I think that excesses are being given away as results are in a lot of small cap businesses. The results are not have not been great, and where valuations were expecting a lot more, I think we have seen corrections. However, many good things are happening, right? I mean, from a point of view of earnings getting better, now it's after 8 quarters we have heard some reasonable improvement in earnings. And I think early double-digit earnings are clearly possible as we get along from here, which I think is a very good sign. Wherever there are excesses in the market, I think they still have a long way to correct because maybe 20-30% of correction in small caps has happened or some pockets has happened. But wherever there are large excesses, still I think over a period of time, if earnings disappoint there, you will have corrections coming through. So I think it's a mixed market in that sense, but getting better.
Okay, all right. Hi, Shailesh. Good to see you in. It's been a while since we chatted, and you're sounding reasonably optimistic on the markets from here on. In terms of, policy support, we've seen quite a bit, right? Both from the center as well as from the RBI. Anything more you're factoring in terms of, support from the center? Because now it seems that, their headroom is limited out there, going by the kind of freebies that are going to be doled out. The revenue collections haven't been as much as expected, and the capex spend has been higher. So your view with regard to actions from the center as well as from the RBI towards the end of this year?
I think there have been multiple action points which have happened. I think there is very little left to be done. I think it has got to do with the fact that now corporates start investing and general volume growth revive. See, a lot of challenge has been that large volume growth revival has not been there for the last 8 quarters. And when we see that happening or that kind of a revival happening, I think automatically the whole cycle will turn. So the GST cuts have been phenomenal. In my opinion, they will have 3-4 years of 5 years of benefit because it's not going to be just 1 year bump.
Right.
And even income tax cuts actually benefit for 2 to 3 years. So I think a lot of good things have happened and laid into play. I think the only problem was our markets were expensive. The money which had flown was significantly taken higher risk in pockets of the market, and which led to mispricing or excessive pricing, which is actually getting corrected. I think fundamentally a lot of things are in play, especially in the large cap side of the market. And in the small cap and mid cap, earnings will revive over the next few quarters, but more importantly, some valuation challenges still remain there. So you have to be selective there. I mean, that's the way.
Okay, all right. And, the two big beneficiaries with regard to the GST cut have been autos as well as consumption. Your view on both those two sectors?
So auto is clearly the single biggest beneficiary of this GST change, because I think that is visible in the first round itself. And more importantly, I think this will be visible for a 2-3 year period. I don't think these cuts only will help today, because they've repriced a lot of things and allowed a lot more consumers to come into the participation space. So I think auto clearly remains a very, very strong opportunity, especially the passenger four-wheeler space, right? Because there has been slow growth for the last several years there. Coming to the consumption side, right? See, consumption side has been suffering more from lower volume growth because of the real slowdown in the urban as well as the rural side of the market for last 8 quarters now. I think there is less optimism there, but I think where there is zero optimism, even if there are small changes in terms of earnings and all, I think there is opportunity for returns to be made. A lot of these companies have derated now for 5 years, 7 years, right? And it's now we have seen some of them now talking about pushing volumes at the cost of margins, driving growth. I think when the direction changes like this, in all probability, next 3 years will be good for consumption.
Got it. Okay. All right. Shailesh, let's talk about, this RBI cuts. And a lot of attention on the NBFCs. The cost of borrowing goes down, and there's hope that credit growth continues to pick up from here on. How are you all placed on that space? Because, we talk about FI selling and not participating too much. There'll be that split argument that they participate in the primary market, maybe they're selling in the secondary market. But the sector that's got a lot of interest and has got an earnings tailwind as well is the banks and financials. How are you all placed there, and what do you like?
Yeah. Clearly, large banks and large NBFCs are still far better priced than most pockets of the market.
Okay.
They have seen their challenges, and a lot of FI selling has also been in these pockets till the last few months, right? And hence the prices and valuations are still sensible compared to most parts of the market. If you look at some large banks haven't delivered even single-digit return in the last 12-18 months. So I think the valuation comfort is significantly there. And the whole upside from a point of view of credit growth coming back and margins stabilizing and improving, I think it's lies still ahead of us. So within the available spaces which are there today, banks and insurance in these spaces are far better priced, especially large banks and large financials seem to be very sensibly priced there.
Okay. The other debatable topic has been on tech.
Yeah.
The bearish argument is no growth, why to give it a multiple? The bullish argument is, if you look at the cash flow yield, it's very good. Maybe the worst is in the price. Underperform, under-owned. Which camp are you in, Shailesh?
So clearly, I think there are, the challenges which are there, right? They are visible to everyone now. I think so. It's a visible challenge, low growth, but I think valuations are far more sensible than they have ever been, I think, in the last 5 years. So I think we are more towards looking at it as at least a market participant. And I think if there are surprises in terms of growth continuing to be maybe early single digit or rising to 7-8% over the next 2 or 3 years, I think you can find reasonable returns to be made. See, growth is a little slow everywhere. I mean, so it's like relative growth is possibly likely to turn here, and expectations are very, very low. Like in consumers, the expectation of recovery is virtually not there. Even in IT service, expectations are running very low. Most people will talk about 5%, 6% kind of growth expectations, but end of the day, in their minds, I think they have believed that IT services cannot grow at all from here. But I think the pricing for that and the valuations for that, most of them would be at 4-5% dividend yield and throwing significant cash and can re-engineer. I mean, it's possible they re-engineer. So we are more on the positive side from here on than possibly last year, because there is enough and more derating in that space.
Okay. All right. Final word before we let you go with regard to returns. Getting into 2026, it's been a challenging year, actually. The Nifty to get away even with a close to double-digit return is very, very heartening. Do you think investors should brace on an average for the next few years of low single-digit returns? Would that be a fair ask? Because I'll tell you what, the period post-COVID spoiled a lot of investors. People got used to saying 20-25% is par for the course. That's not par for the course. Do you think low teens returns from here on is something that we can expect in the coming few years?
Low teens is a best case scenario for returns, I think, is what we see for the next 3 years, unless there is some explosive growth recovery. See, a few things which we are not in full control is what's happening in this global geopolitical side. If things stabilize there, growth recovers for some reason, those could be surprises, but you can't go in with those assumptions being in your favor. So I think earning-led returns is what is possible, and earnings generally can trend between 10 to 13% is what we see. And if you have this kind of a outlook, and this kind of multiples as a starting point, I think P multiple re-rating is maybe a very small probability event from here. So I think it's more earning-led, and hence returns would also possibly follow and track earnings. I mean, that is where I think the base case is for us.
Shailesh, the other trend of the year has been the red-hot IPO market and the underperformance of the broader market. I mean, this has largely been a rally about big banks, the larger stocks, right? So two different questions. One is on mid-caps. I'm sure you get asked this all the time, that from here on, now the Nifty is at an all-time high, broader market hasn't performed. So do you expect a better recovery in mid-caps and small caps? That's one part. And secondly, what do you think of the super hot IPO market?
The recovery in earnings has to be there to drive the recovery in small and mid caps, right? So if you look at both small and mid caps separately, mid caps still trade at fairly expensive valuations. So they have not corrected so much. They've actually done well versus what expectations were last year. And these are very high quality businesses between 30,000 crore to 1 lakh crore market caps. And they have done reasonably well, and they have not corrected so much. So there is no easy money lying there. Only earning-led return possibilities exist there. In small caps and more in smaller small caps, the corrections have been sharp. If you look at corrections below 10,000 crore market caps has been very sharp, and generally between 10 to 30 have been okay. So I think there also internal markets are a little too different there. So where there are substantial derating already happening, I think maybe there are some opportunities which are coming about. We have seen some in QSR space, some in some other areas. But in most places, there is still either a valuation correction or large earning positive surprises have to come for us to make good returns out of it. So we think still a SIP-based approach to these categories is still a better way for at least the next 12 months, and then possibly either earning uptick happens sharper than what we are anticipating, which can lead to possibly better returns. On the IPO market, I think it's the most debated. So clearly there's a lot of supply. There's a lot of FOMO, and we've seen a lot of participation by a lot of investors. And we think given just the flurry of IPOs and generally the pricing of IPOs, you would find that because there is very limited time in evaluating these businesses, and these guys don't have a governance track record because they've not been in public markets till now. So at least the public market governance track record is not there. I think this market will have or can potentially have challenges in the next 3 years. So investors looking at this market and investing and choosing have to be extremely, extremely careful in terms of, one, what valuations are paying and what type of managements and businesses are being backed. So I think clearly there is significant supply. And also the fact that the supply is not at very attractive prices. So typically a company without a 5-10 year public track record should actually come at substantial discounts to listed companies. And when we are finding listed companies themselves expensive, then you would expect that the IPO company should trade or come at far lower valuations than that. But because of the demand and because of the significant interest there, we are not finding valuations cheap there at all.
Ah, okay. Well, it is a red-hot market, so I guess the message is tread with caution. Yeah. Take that on board, Shailesh. Thank you very much for joining in. Great conversation. We look forward to connecting again soon. You have a good rest of the day. Well, with that, let's move on. We have Nimesh joining in with today's standout brokerage report of the morning. Nimesh, which one have you picked out?
Hi, Surabhi sir. Today's standout is on Paytm. In fact, the stock is reacting as well. The biggest F&O gainer. We missed out highlighting in pre-open, but nevertheless, there's a big upgrade coming in from Goldman Sachs and Paytm. So they've upgraded the stock to a buy, and they've raised the target price sharply to 1570 versus their earlier target price of 705. Now, they believe that the regulatory environment, which has been the biggest drag on the stock in the past, that is incrementally getting better. In fact, Goldman believes that this is going to translate into an early signs of recovery for Paytm's payments business, as well as the earnings visibility. So Goldman is now saying that the company can sustain 20% plus revenue growth in the foreseeable future. Additionally, there could be more upside to the earnings if there is any positive changes in the intervention of the payments market. Basically, they mean if there is any increase in the MDR and that would mean there could be further market share gain as well. On back of all this, Goldman Sachs expects that the EBITDA margin can double for Paytm in the next 3 to 4 years, and at this price, the risk reward is quite favorable according to the Goldman. So hence, a big upgrade to a buy now on Paytm, and Goldman has sharply raised the target price now to 1570.
Okay, all right. We'll keep this on the radar. Stock's doing well right now. Thank you for highlighting that, Nimesh. Well, with that, let's move on to another corporate conversation. And we're putting the spotlight on the IT space. And the company on our radar is Happiest Minds. Now, you would have seen that over the past couple of weeks, several brokers, including CLSA and Motilal Oswal, they have upgraded the IT sector. And they're expecting a better performance going ahead. So is there something really shifting on the whole AI front? Is the second half going to be stronger for Indian IT companies? Well, let's put those questions to Venkatraman Narayanan, MD at Happiest Minds. Venkatraman, thank you very much for joining in. And I really want to start right there. We're all trying to understand the implications of this great AI moment for India. And I'll tell you what has shifted. A lot of these brokers whom we spoke with, their argument is that the AI build-out stage is probably peaking now. You know, the billions and billions of dollars of infrastructure that the likes of NVIDIA and the others are putting up. But as we move deeper into the AI adoption stage, that is when Indian service providers will make a comeback. And the use of AI in the delivery of services, that's where the numbers and the growth and the deals will start coming back on stream. Now, you tell us, you're a participant, so I'm sure you'll have, to that extent, you'll have a slightly biased view. We all want to believe this. But can this really happen? What are we in for as we're looking at AI and Indian IT in 2026?
I think you got it absolutely right. Just like any capex cycle, you have a capex build out, and then the revenue cycle starts after that. If you look at the AI boom or what's been happening across the world, it's been billions and billions of dollars being poured into the infrastructure part. But for anything in the tech or technology space to really take off, you need to create ecosystem. You need to take up. There has to be adoption, and both of these happen only through what you call a social media effect, or what you talk about adoption by people who want to use it for furthering their business. So until now, what's happened? The infrastructure build out is happening. You have got the large tech companies pouring billions into it. Now, to make sense of this for the enterprises or for application service providers, you need the services to be built around it. And then you have service partners like us help that build out. And this has been how it has been, let's say, many years back when the ERP boom happened, where the software services, people coming out with big bang approach on the ERP, but you then need the consultants to do the re-engineering, remapping, and implementation. And that's where the consulting services companies and the tech services companies really came into, to the fold.
But Venkatraman, if you could dive a little deeper, what makes you confident then that Indian IT service providers will be able to capitalize on this opportunity the most? I mean, there will be competition from the likes of an Accenture and the other big, consultants as well. So, and till now, we don't have very definitive numbers for the industry as a whole, even for individual Indian companies, that, what will the AI part of the revenue be? So for the street, it's also a little hard to map this. If you could give us some more light.
Yeah, I think we have been one of the very few companies who have set out ourselves the goal of, setting out the numbers that we get from AI. We started out by making it a segment for ourselves.
Yeah.
So right now, 2.7% of our revenues comes from AI. The difficult thing out here is almost all the work that we do today is AI-led. How do we differentiate between what is core AI versus what is AI-led? But that's a challenge that we'll come up to later. But as of now, the way we are identifying core AI business is about 2.7% of our total revenues. And we are looking at that growing to about $7 to $8 million by the year, and grow to 5% very quickly. And we have also put out the points that we have got 22 use cases right now, replicable sales or replicable use cases, which help enterprises adopt and make the most out of the AI infrastructure that's being built out. So that's something that we have set out, and we have also said that the revenue potential for somebody like us is about $30 to $50 million from there. We have signed up 30 new customers, and almost all the customer signups I would say 28 or 29 out of the new customer signups that we have had have been AI-led. So you're seeing how we are becoming, the approach of being an AI-first, AI-led company is helping us. And all of this on the services front. Let me say that as well. Because, we are not doing anything on the infra side or setting up infrastructure side. Yesterday, for example, we have launched our own agentic AI support AI platform called Elera. We have released a press release on that. Shows that we are getting ready to even tackle the L1, L2 part of services side from with agentic AI support. So this is where we are coming from. And the Indian IT services company, when we say we have done 22, I'm sure the other companies are also building out similar use cases, and they are also.
This Venkat, this $30 million of an expected pipeline, AI pipeline. This is over how many quarters? By when?
No, we have not given. We have said over the next couple of years. That's what we have said. Because you have 22 use cases. We have started seeing traction with our existing customers, and then you do an arithmetic of how you will sell this into existing and the new customers in the prospect database, and have come to a number that's how we have come up with this $30 to $50 million.
All right.
Just like the 30 signups will likely lead up to $50 million is what we have said. Because what's the kind of run rates that we have today? You have the run rate multiplier, and then that comes to about $30 to $50 million. You have to build it piece by piece.
All right. Hi, Mr. Narayan. Good to see you, Ben, sir. Give us a few more details. Sneak peek into quarter 3. How have deal wins been? How have logos been? And if you could give us a sense on furloughs for quarter 3, a broad sense.
We have not seen that high numbers in terms of furloughs as of now, or at least we have not got any indications of that. Because in our business, as we have said in the past, we do have furloughs with a couple of clients, but it's not something that's uniform. Yes, Q3 for the industry typically is slightly on the weaker side, but we have been confident. We have said that we'll do our double-digit growth for the year. We have done 11.8% half year over half year in dollar terms, and about 2.3 QOQ and 6.7 half year over half year. So what we are saying is we'll see a similar kind of growth continuing in Q3. We will have some small impacts of furloughs, but then we missed out some growth in Q2 thanks to pushing out of the product, the Artha banking product revenues going into the next quarter. So that should help us set off. That's how the numbers stack up for us in Q3.
Okay, and you're rather confident, right? Next few years, double-digit revenue growth is there for the taking.
That's right. That's right.
And all
in fact, I had the opportunity of hearing the gentleman just before me from Nippon. He was talking about how the expectation is very muted from the tech sector. So I would say, compared to that, happy to say that we are still keeping our numbers high at about double-digit growth, and hopeful that we'll continue to perform on that basis while capitalizing a lot on the AI flood that's happening currently.
Any inorganic growth is what you're looking at?
Yeah, that's something that's consistently on our radar. When we have something more solid, absolutely, you'll be the first to hear from us.
Venkatraman, what will this AI expansion, what will it mean for margins? In the past, you've said that you'll probably be maintaining margins at the current level of around 20%. But what's going into those conversations on pricing, on upskilling the workforce? Tell us more.
Yeah, so on the margins front, I think it's only going to improve because the AI business of ours has started breaking even. I would think at least 6 months ahead of what I thought it would. I'm happy to say that from Q1, Q2, we have started breaking even, and it's starting to pull in margins into the company. So that's something that's been helpful. The new sales engine, which is where we were pouring money in or investing, that's also beginning to show results. Like I said, we have got 30 new logos, and it's that with potential of $50 million over the next couple of years. So investments that you make are beginning to show results and help margins. On the pricing side, yes, AI, the pricing for AI capabilities or AI services is slightly a notch higher than what we do in the digital side. So that's something that's helping us. But yes, continued investments into new technologies, retraining people, making sure that utilization continues to be high, because that's a challenge. You have to retrain, repurpose, get people adapting and adopting the new technology. So for that, we will be making investments. Also, the compensation levels could be slightly higher. So that those things will continue. It's something that we have to do.
So to go back to the timeline that you shared, by the time that you are pulling in $50 million from AI, and you said that's over the next couple of years. I mean, what is the margin trajectory? Will it be slightly higher? But then you were saying that obviously you have to pay more to these.
It should be higher. It should be higher. Today we are at an operating margin of about 17.2%. And this is, I don't want to use the way slide down, but it has come down from the 18.5, 19% in the earlier part of, let's say, early part of last year, primarily because of the investments that we made. So these investments, when they start paying off, you have to start gravitating towards the 18% operating margin. So the thought is always to grow with margins, protecting margins and growing margins.
Final question, sir, before we let you go. What about your investors? They have been hanging in there. Those that got in the IPO will still be happy. But some who have bought in the last few years, they'll be wondering what's happening to the stock price. Management sounding optimistic. Yes, the sector has gone in a bit of a tizzy, but the stock price has come down dramatically. If you were to give them a message, what would it be?
Stay strong. Again, I'll go back to the conversation the gentleman was talking about before me from Nippon Mutual Fund. He was saying that, an IPO is only start of the journey. We are 5 years into the journey, and we have not, caused despair to our investors, at least from the performance, the company's fundamental performance. Pricing is something, which is relative, which has got quite a bit of sentiment attached to it. Many of them beyond our control sometimes, and that's what seems to have happened. But as an industry, we stand tall, we stand strong, and I think the AI, there was a little bit of angst with AI, but I think the industry will continue to grow, will continue to take up every opportunity to go deeper, work for our customers, and make sure that we really pay back our shareholders and stakeholders.
Well, I think those shareholders are happy listening to you right now, Venkatraman. Stocks up 6-7 rupees over the course of this conversation. So we wish you, your teams, all the very best as you move forward. But there you go. I mean, you have an industry player basically verifying what some of the analysts have been saying, and that's the point that we've been making, highlighting some of the brokers like CLSA, like Motilal, all of them saying that you have to move past the build-out stage. That's where India wasn't present. We don't have billions of dollars pouring into AI build-outs, the chips and the data centers, etc. But when it comes to using AI to deliver services, that's when the Indian companies will make a big comeback, something that Mr. Venkatraman has also agreed with. With that, let's take a very quick break, but we'll come back on the other side. The corporate conversations continue, and we'll be in touch with the management of IGI, International Gemological Institute, and we'll figure out how the second half trends are looking like for the diamond certification business.
Welcome back. Well, just a quick check on some of those metal-related stocks. As our ticker team was telling us, silver prices are moving to fresh all-time highs, and that's why Hindustan Zinc is seeing very, very high volumes for the first 30 minutes odd, because that's the only play on, on silver. So that's up close to around 1.5%. Very, very volatile moves is what we see on Hindustan Zinc, so keep that in mind. And IMFA is the other stock actually that's higher because ferrochrome capacity is globally, there's been a bit of a shutdown owing to the high cost of production. The recent shutdown overnight is the Samankor chrome, smelter that we saw. So the overall cost of production is going up. That's resulting in higher ferrochrome prices. And in turn, IMFA is gaining because they're backward integrated. So explains why a stock like IMFA is up close to around 5% or thereabouts. That said, let's move on to IGI. We have Ishwar Iyer, the CFO, who joins us on the show. Hi, sir. Good morning. Good to see you in, Mr. Iyer. Tell us, how are you seeing business prospects shape up? And, what's the outlook like towards the end of this year and for the next year as well? If you could quantify the kind of growth and profitability you're looking at.
Well, good morning, Nigel, and thanks for having us back on the call. Yeah, it's been some time since we last met. I think the Q3 performance was in sync with whatever we have actually been speaking over the last 2 quarters prior to that. We grew around 26% on volumes and around 20% from a revenue standpoint for Q3. So YTD, in line with what we had given as the guidance at the beginning of the year in terms of 15% revenue growth and 20% EBITDA growth, YTD we are at around 16% of certification revenue growth, and EBITDA growth is around 22%. So I think we've been on, in terms of whatever guidance we had given at the beginning of the year, we seem to be, being able to deliver that during the course of the first 3 quarters.
Okay.
I think the business continues to be robust. Obviously, we're expecting some headwinds because of the tariff, etc. But that haven't played out, at least in Q3. So we continue to remain very optimistic about the business performance for the Q4 and again for the next year.
All right. So you're saying, 15 to 20% revenue growth is something that you should be growing from year on, and margins holding in the mid-60s. Is that correct?
That's right.
Tell us about growth, vertical-wise. How do you see the revenue mix shape up? Because last quarter we saw the natural diamonds out there, that segment growth was even higher than lab growths. Is this, a bit of a turn, a bit of a pivot that's taking place? Do you expect more of the same?
Yeah, I think, Nigel, I think while the lab-grown segment has enabled us to propel our volumes over the last 3-4 years, I think our focus remains on certifying diamonds. So we have separate verticals to manage natural diamond, the business, a separate vertical to manage the lab-grown diamond business. So each of the functions are delivering in terms of, what is the expectation as far as either gaining market share or holding fort where we have high share. So I think all the levers have worked in Q3, and also it coincided to be the Diwali quarter, right? So we have obviously natural diamond and natural diamond jewelry also shaping up pretty well. So yes, natural diamond had an exceptional quarter. We grew some 29% in this quarter, and YTD again we are at around 14%. So I guess this is a combination of being extremely focused on the key revenue segments for us, which is both natural diamond as well as lab-grown diamond sector. So from that context, I think we've seen some extremely strong performance across all the 4 segments during this quarter.
So, Ishwar, however, this trend that we've seen with the natural diamonds doing better for you this quarter, was this just a festive season phenomena, you think, or is there something more to it? Is there something more changing?
See, I think we're making significant investments as far as building capability around this vertical as well, because the natural diamond segment is an important segment for us. So, from that context, we continue to be extremely focused on this segment as well. So what we are seeing, I think YTD we are at 14%, and I think it's in line with whatever we've been expecting from this vertical in terms of 14-15% year-on-year growth. So from that context, nothing out of line. I think it's in line with what we've set ourselves internally as the target that we have to focus on for the natural diamond segment during this year.
So your average realized price, looking at the data that I have before me, that showed a year-on-year decline to about 854, if I'm looking at the right numbers. I'm guessing this is the average price of certification, right? Can you walk us through what's going into the mix now? Because you're doing, across segments, lab-grown diamond, natural diamond, lab-grown jewelry, diamond jewelry. So how is the pricing shifting for each of these segments?
See, in line with what we've spoken in the past, I think over the last 14, 15 months, we've seen extreme stability as far as the lab-grown pricing is concerned. Obviously, natural diamond or the jewelry segment, those pricing have been pretty stable over the last 2-3 years. But yeah, importantly, the lab-grown businesses remain stable since the pricing correction that we took up last May, which is April, May of 2024. So from that context, pricing has remained stable. Obviously, a slight up and down on the average realization in each quarter is consequent to the mix shift that happens between segments. So from that standpoint, I think we've been extremely stable. Nothing structurally that has changed over the last 3 quarters.
But certification of lab-grown diamond jewelry, again, I'm sure it's a growing business, will be a high-volume business for obvious reasons. But in terms of just the pricing, I don't think this would be too margin accretive at this point, would it?
See, for us, both be it natural diamond or lab-grown jewelry, I think the pricing has been around $3 to $5 per report. I think we are expecting that volume to really help us build up the revenues and the margins. We are not looking at it solely from an average sales price realization standpoint. I think it's an emerging segment for us. We expect the India market, the India consumers to come into the fray. So this this vertical is just starting to build some scale. So I think the focus will be for us from a volume standpoint. We're not too perturbed about what the average realization is going to be as far as lab-grown jewelry is concerned. It's an emerging market. I think we have to participate in it in its fullest form. And with the way the gold prices have behaved, the silver prices have behaved over the last 3-4 months, I think it's an emerging market which has the potential to really leapfrog other segments, because with the combination of lab-grown diamonds and the high pricing for gold and jewelry, we expect this vertical to really dramatically scale up over the next 2-3 years.
And lab-grown, I think, is around $15 per certificate, right?
That's
roughly.
Right. Yeah.
And natural is approximately double of that, if I got that.
Around 3 times, around $40, $45.
40 or close to 2.5 to 3 times at least. Got it. Final question: what about market share?
Okay, again, I think the growth that you're seeing in natural diamond, I think that is consequent to some market share gains that we are seeing in India. Lab-grown, we continue to do pretty well. I think we are a significant player in the India market as well as in the global market. So I think market shares continue to remain stable for other segments, and we are actually seeing some market share gains in natural diamond, which is what is propelling the growth in that segment.
Okay. All right, Ishwar, we'll leave it on that note. Thank you very much for joining in and giving us some perspective on the business. That's IGI as the trends shape up for the second half of the year. Let's look at how trends are shaping up in the market. The good news is that some of the big boys are fighting and fighting really well. Reliance is up a whole 1%. There's a broker note, I think it's a Jefferies note if I'm not mistaken. It's quite optimistic on Reliance, and we'll get to that in just a bit. And then you have Lever pitching in, L&T pitching in, SBI pitching in. Some of the big boys, they have started contributing on the upside. Nagraj Shetty is with us, so let's ask him what the trading approach should be for today. Nagraj, good morning. So once again, getting close to yesterday's highs. We're 50 points away from that. What's your plan for today?
Good morning, Surabhi. Yes, certainly market is in a strong uptrend. Current consolidation after a sharp up move is indicating the uptrend continuation pattern. I'm not expecting any bigger hindrance from here on out, so though there is a slight resistance around 26,300 odd levels. For me, the upside target would come around 26,600 or something, where the Fibonacci extension would cluster in at the higher levels. That is going to be the target for the Nifty in the near term. And on any dips, on any consolidation, 26,000 to be watched as a support level for the market to bounce back.
Okay. All right. Hi, Nagraj. What about individual stock calls?
Hi, Nigel. I have 2 stocks, one from IT side, one from chemical side. IT side, LTI Mindtree, chartically has been in a good uptrend. Higher tops and bottoms on the chart is indicating a positive bias, and currently trading around somewhere around 6,050 levels. I'm expecting this to move up further from here onwards. One can look to buy around this level 6050, and the immediate upside target would be around the 6350 levels. One can place a stop loss at 5850. Second one is from SRF. SRF, after a decline, seems to have formed an important bottom reversal just below the 200-day EMA, I think looks like the worst seems to be over for SRF. Currently trading around 2922 levels. One can look to buy at current market price, and the upside target would be around 3,150 for the stocks, and one can place a stop loss at 2825.
Okay, all right, Nagaraj, we'll leave it there. Thank you very much for joining in. Let's take a quick break. Coming back on the other side, all the commodity cues with Manisha Gupta. So both the notes that have come out from Jefferies are seeing stock reactions today. Lenskart is one. Lenskart is at 414. Jefferies thinks the stock can go to 500. They are identifying some levers there. And the other one is Reliance. I'm just checking the price target on Reliance, 1785. That's what Jefferies thinks Reliance can do. It's basically highlighting, the brokerage is highlighting that all of Reliance's businesses are firing and are all set to deliver double-digit growth this year. And they think that with the Jio IPO happening, perhaps there will be another round of tariff hikes. So those are some of the triggers because of which Jefferies feels that Reliance is all set for higher levels. And it's definitely helping the market's case as well today, taking things up and higher. We'll have Manisha join in the next couple of minutes. By the way, look at GAIL. GAIL has still not recovered. Despite all the assurances from the PNG RB that this is only an interim relief and more will happen in FY28, The fact is it's been disappointing for the market. The market expected 20%. The company was seeking a 33% hike. What has been delivered is 12%. And that disappointment still visible on GAIL. But Nigel, the rest of the market has moved on. 50 points up on the Nifty now. So it's perked up.
Well, that's right. And the stock that we just highlighted, Hindustan Zinc, the only way to play silver, because I think close to 45-50% of the EBIT comes in from the silver business. That's moved to the high point of the day as we speak. Volumes fairly high as well. But on that note, let's hop across to Manisha. She's here to tell us what's going on in the commodities market. Manisha, take it away.
Well, taking cue from what you were just talking, Nigel, I'm talking about silver, by the way, because we're just $0.50 away from all-time highs yet again. So 54.5 is an all-time high, and we seem to be trading around that $54 ounce mark right now. For the year, prices have gained up by 87%. And, the silver rally started from mid-October in 2023. So when you look at the prices from there on, it has gained 165%. That's the kind of return that silver has given you in last 2 years itself. In the month of October, 2023, silver was trading at around $18 to $20 an ounce, and it's trading at 54 right now. All-time high has been 54.5. We started this year with 29.5, and it constantly has been gaining since then. We did 45.5 by the month of September, and from there till time, it has been $10 an ounce of a jump up coming in. Silver has seen some profit taking since the time we saw all-time highs there. It did go down to 47 as well, but the rebound that we have seen in the month of November clearly has been quite strong, giving us nearly 15% of gains for the month of November itself. Well, 85% probability of a Fed rate cut in the month of December is something that has been supportive. And then the street is counting in that you might perhaps be looking at 3 more Fed rate cuts by the end of 2026. And that is the whole of next year is also supportive for prices. Take a look at the kind of silver demand that we are looking at. Well, the industrial demand, we did see an all-time high of around 689 million ounces last year. And the expectation is that you could be looking at that number or slightly higher, up to 700 million ounces of a record number in sense of industrial demand for this year as well. Within the industrial demand, it is the solar panels which really are giving us a very, very strong numbers coming in there. And that is what you should be looking at, because 2020, the solar panel demand was at around 94 million ounces. Last year was 243 million ounces, with an anticipation that way the industries are going towards solar panels, not just India, but various other global markets as well. You could be looking at some more support continuing there. Take a look at the silver market deficit as well, and that has continued to be on the stronger side as well. This is going to be a 5th straight year that you're looking at a deficit in silver space, and that has been supportive. And then, of course, we are looking at strong physical, ETF, institutional buying. All of that has been very, very supportive. A lot of people bought physical silver in India, and that has led to a lot of premium coming in for the markets as well. Well, where is silver headed going forward from here? Macquarie, for one, is the most bearish of the lot. They expect that silver could be looking at an average of $35 an ounce of a price in this year. Everybody else is into 40s and then in 50s as well. World Bank, Citi, Deutsche Bank believe that $41 to $45 of an average price is what you could be looking at in case of silver. Target prices for silver on the higher side could be as high as 65. There have been targets of 70, 75 as well. But most bullish clearly seem to be Bank of America and Goldman Sachs. We're giving up $65 an ounce of higher side targets. So while we are very, very close to all-time highs for silver right now, the expectation is that you could be looking at this outperformance continuing in next year, and much higher highs is what you could perhaps look at.
Okay, all right. Thanks a lot for that, Manisha. By the way, some comments coming in from the HAL chief clarifying that there's absolutely no problem in Tejas, and saying that that export potential does continue. Some initial comments that are coming in there. Keep an eye out on the bottom of the screen. Post those comments. We are seeing that the stock has perked up a little bit on the screen. But talking about stocks that are perking up today, Lenskart. Jefferies has taken a closer look. The lens is on Lenskart. They believe that the stock could head higher from here. Vinny joins us to give us details on that particular report. Vinny?
Hi, good morning. So Jefferies has initiated coverage on Lenskart, buy rating, target price of 500 rupees per share. And do not forget, it is India's largest tech-driven eyewear retail holder with 5% market share. Now, what will do well? One, they believe that offers are quite strong in terms of the growth potential that is there, that comes in from Lenskart's point of view. Other than that, they believe verticals, they're quite integrated, omni-channel model that is working out. So cost efficiencies there, rapid deliveries there, superior customer experiences there. And India serves as a bedrock with more than 85% contribution to EBITDA coming in there. Also, they are seeing that there is good unit economics, which are quite attractive, fast payback is there, and that should be something that will drive a 50+% adjusted EBITDA CAGR growth. So they're quite positive on the growth for the company in the next 3 years as well. And do not forget, the company will be reporting their numbers tomorrow, so we'll keep an eye out on that as well.
Okay. All right, Vinny, thank you very much for that. We'll take a quick break on that note. We'll come back on the other side and get you excerpts from our exclusive conversation that we had with Jonathan Garner of Morgan Stanley. Okay, keep your eye on the IT index carefully, because what has just come through is a very, very, very long, elaborate Thanksgiving post from the US president. What is important for us is that he is calling out for, immigration and how there needs to be reverse immigration out of the US once again. And for the benefit of our viewers, I'll just read this out. Some of the flashes are all on your screen. He goes on to say that, the goal will be pursued with the aim of achieving a major reduction in illegal and disruptive populations, included those admitted through an unauthorized and illegal approval process. And then he's saying that we will permanently pause migration from all third world countries. So, and then he goes on to say that we will pause migration from for immigrants who are not in sync with the Western way. So some of this is fully open for all kinds of interpretation, not quite sure. what the specifics of this will be, but it's something that's really important. Even as we have progressed technologically, immigration policy has eroded those gains and living conditions for many. I will permanently pause migration from all third world countries to allow the US system to fully recover, terminate all the millions of Biden illegal admissions, including those signed by sleepy Joe Biden's auto pen, and remove anyone who is not a net asset to the United States or is incapable of loving our country, and end all federal benefits. Now, again, like I said, it's very, very loosely worded. How do you define who is not a net asset to the US? Short point is, from a market perspective, we need to keep this on the radar. The Nifty IT index is not just the best performer this week, it is among the best performing indices this month. And some profit taking is getting triggered. Some of this could just become excuse to take profits. And you just heard that conversation with Happiest Minds. Off late, the street has started taking a more favorable view on IT stocks, seeking, some value buying at lower levels after a long underperformance. So if you look at a one-year chart on the Nifty IT, it hasn't done much. It's still about 18-19% off the peak. But the last 1 month has been very positive for IT. But now these comments on immigration come in, and they have led to some caution. Now look at that. A very sharp profit taking on the IT index. Let's pull up individual IT stocks. Let me quickly check if some of the bigger names, whether they are seeing any reactions as well. Pull up Infosys, it's down about 0.5% right now. Wipro is also losing some of the morning gains. HCL Tech is slightly lower, and TCS will come up on your screen as well. So IT becomes a watch point given all this commentary that's coming in from the US president. We'll get you more on this as it transpires, but actually there is no more. He has simply said that anyone who is not fitting in with the Western way of living, anyone who's not a net asset for the US should not be allowed to stay in America. But it's also in contradiction with a lot of the commentary that he said on immigration in the past, specifically when he was talking about all the investment, for instance, that South Korea is going to be making in the US, where he says that we do need smart workers to run those factories, which are being put up with the help of investment coming in from some of these Asian giants. So let's see. Many times Mr. Trump ends up contradicting himself. We'll have to wait for the fine print on this one. In the meantime, let's get you a special conversation. As the Nifty scaled new all-time highs on Thursday, we caught up with Morgan Stanley's Jonathan Garner about the Indian market. And we began by asking Garner, who still remains very overweight on India, by the way, whether he thinks that the Indian market is once again looking attractive to foreign investors.
Yeah, so India outperformed 4 straight years, 21, 22, 23, 24. So you're right, there's been somewhat of a give back in performance relative this year, though obviously the absolute returns have been there to some extent. As that's happened, the valuation relative has fallen substantially from about 1 standard deviation above long run average versus other emerging markets to about 1 standard deviation below. And I think the reason that relative derating happened is that relative earnings growth momentum slowed. So we had a marked pickup, particularly in North Asia, in markets like Korea and Taiwan, which are very rich in terms of semiconductors, tech, hardware plays on AI, and to some extent, some limited extent in China. Nominal GDP growth slowed in India, slowed probably more than we thought at the beginning of this year. But as we look forward, our economists are resolute, and certainly, as you just mentioned, the market's starting to react to this with the idea that the policy stimulus that we've had in India is going to drive quite a meaningful upswing in nominal GDP growth, and earnings growth should accelerate from something like 7%, 8% to mid-teens next year. I think on the other part of your question, I think often when I've been on your shows, you've asked about the foreign investor, the FIIs. There is foreign investment participation in India on an ongoing and daily basis, and India's had a very vibrant IPO and secondary market, and it's a much wider range of investors that participate in the market than did in the past. So I wouldn't actually characterize it as being the case that foreigners have sort of been leaving the Indian market, or that something caused them to move out of this market in a major way this year.
What's the overarching view on Asia and emerging markets? As we were discussing, emerging markets have come off an exceptionally strong year, particularly, say, a Kospi. That's up 66%. But the gains are concentrated. It's led by AI, semis, all the technology plays. So first, if you could tell us the big view on emerging markets going into 2026, what do you like, what do you not like, and why? And secondly, if the AI frenzy were to cool, not a bubble, pricking or bursting, but just some moderation in the optimism, then how does it affect the dynamics?
Thank you. That was another two-part question. So I'll try my best to remember both parts of the questions. So I think the first part of it about emerging markets overall, I mean, this year we had a tailwind from a weak dollar, particularly in the first half, and that eases financial conditions in emerging markets. We had a lot of multipolar world dynamics, as we call it, the whole trade and tariff debate. And that certainly around April, May caused almost all markets to fall. When we actually... Sorry, I can hear some feedback. When we actually go through the second half of the year, it's right, that dispersion in performance was very significant. But going into next year, we are recommending quite tight market risk positions. So we do have an overweight India, but it's relatively small. And most of our other market calls are relatively contained. And we're just arguing that to have a robust approach, investors need to focus on stock picking and they need to be quite nimble. We're not done with macro volatility globally. We're living in very uncertain times. So it's not a sort of a bang the table opportunity on any individual larger market here for us. Thank you.
Jonathan, coming to India itself, before I get into macros and the sectors that you like, Maruti, that is one stock that is on your focus list, right? I wanted to understand what do you like about it right now? You called it a potential beneficiary of the GST reform and product pipeline strength. So what differentiates Maruti today versus 2 years back when we were talking about it suffering from the EV threat? What makes you so bullish on this one?
Yes, I mean, in terms of talking about individual stocks, I don't tend to do that on these because we have analysts that cover them. But what I would say is that it's in the right space in terms of GST, it's consumer discretionary. So when you get these cyclical upswings in activity, it's the kind of thing that tends to work well. And obviously, it's a stock that our analysts cover and that we know well.
What about sectors in general? You have highlighted more upside in, say, financials, industrials, and consumer discretionary. What is the strongest bottom-up signals that you're getting from these three sectors that make you bullish here?
Yeah, we're overweight financials, consumer discretionaries, under industrials. Those are actually calls that we're making generally across Asia. For example, if you were to look inside the Japanese market, we have much the same calls. We're underweight energy, materials, utilities, and healthcare in the Indian market. And so there are some quite pronounced sector relative calls there. I think for the energy sector generally, obviously it's more downstream in India than upstream, but it's a sector that is struggling as we go through an energy transition. And in the materials sector, we also have sort of a broad negative call on that outside of some very specialized areas like rare earths or gold miners and things of that nature. That's not very easy to access those kinds of names in the Indian market. You can find them in places like Australia, for example.
Jonathan, you mentioned we are living in uncertain times and the fact that the macro instability is not over yet. But India as a economy in general has had relatively stable macros, right? Because the first quarter GDP print was fairly robust, almost close to 8%. Polls for the second quarter GDP are also indicating a similar sort of print at around 7.5%. Do you see this economic stability as an outlier compared to a lot of the other global markets, or will this uncertainty around this trade tariff deal with the US be a bit of a dampener going into the second half?
Yeah, so actually the drop-off in inflation in India is important. I mentioned in answer to your earlier question, nominal GDP growth, which matters much more for corporate top line than real GDP growth. And I think that's where the negative surprise came in. I think effectively the decline in inflation is telling us that policy was too tight. And likewise, credit growth actually falling to low single digits. This is not what one should be expecting from an economy that is still developing very rapidly. So what we're anticipating, hopefully, is that with the policy easing measures that we've had, the nominal GDP growth environment will accelerate, as I said, from kind of mid-high single digits to mid-low teens in the course of next year, and that will reignite the corporate earnings profile, which softened relative to those markets we talked about earlier that had a very strong year, the AI tech, semi-capex kind of markets. They, by the way, are likely to continue to post strong earnings growth next year, maybe decelerating somewhat, but they will still be growing earnings next year.
Jonathan, we have been talking about how global markets have been faring, a lot of macros as well. You are seeing some upside for Japan as well. But, there's some nervousness around yen carry trade. We are talking about yen strengthening, yields are jumping. Do you think this is something which could impact markets globally and Asia as well?
In a word, not really. In a sense, what we're seeing is a normalization of yields in Japan from very low levels, consequent upon the BOJ intervening less in the government bond markets, which is a very healthy development, and the fact that reflation is ongoing. If you look at Japanese 10-year yields, they're about 1.8%. That's still less than a half 10-year yields in the US, for example. And if you look at the underlying situation vis-a-vis the yen, it's actually strengthened this week after we got the details of the fiscal package. And the fiscal package itself is entirely financeable. Japan is amongst the G7 almost unique in running essentially a balanced fiscal position relative to GDP. It's less than 1% of GDP fiscal deficit. So it's more than able to expand its fiscal impetus here. So the yen is undervalued. We think it will strengthen back towards the mid-140s over the next few months. And I think that process began in the last few days.